You're watching Big Future's Guide to Alternative Assets. In addition to the major asset classes of cash, bonds, property and shares, there are other types of assets, which are collectively known as alternative assets. These investments tend to be specialist and unconventional in nature and are often less liquid than traditional asset classes. Alternative assets include things such as hedge funds, private equity, infrastructure investments, catastrophe bonds, and other types of leverage or illiquid funds. The two most common alternative assets are hedge funds and private equity. Hedge funds often have an objective to make a positive return even when traditional asset classes decline. Most hedge funds have some common characteristics. They often use bank borrowings or derivatives to leverage their financial position. Leverage means having more invested in a financial position than the value of your initial investment. Hedge funds have higher fees than those paid for traditional asset class funds. Hedge funds justify their higher fees by arguing that more of the return is due to the hedge fund manager's insight or skill. Hedge funds usually have complex legal structures, are regulated differently from traditional managed funds, and often cannot be sold directly to retail investors. Finally, the minimum investment amount for many hedge funds is typically large, too large for the average retail investor. Investors include hedge funds in their portfolios because they believe investment returns are not correlated with the major asset classes. Private equity is an investment type almost exclusively reserved for sophisticated and institutional investments. However, you may have this type of investment in your superannuation fund. Private equity investing is when a fund manager owns a company directly. There are all kinds of situations that call for private equity investing. A company with a new idea getting started, a family business maturing, a non-core business unit spinning off from its mothership, or just a compelling growth opportunity. One of the distinguishing features of a private equity fund is that investors' money is usually tied up in the fund for 7 to 10 years. These investments are very, very illiquid. Like hedge funds, private equity investments are often in a private partnership and have higher fees. Also like hedge funds, private equity returns are often based on the skill of the managers. Fund manager fees are high, and a large portion of the fee paid will be performance-based. Sophisticated investors include alternative funds in their investment portfolios as a way to diversify returns away from major asset classes. These investments are typically not suitable for retail investors as they require due diligence in the investment manager, have higher fees, and are often illiquid. To understand more, visit bigfuture.com.au.